What if you could own a piece of more than 10,000 companies around the world with a single purchase? No stock picking, no research reports, no betting on one company's earnings call. That is exactly what an ETF, or exchange traded fund, makes possible. In this video, you will learn what it is, how to evaluate one, and what mistakes to avoid before you buy your first share. Most people who want to start investing feel stuck at the same point. They search for the best investment and find contradictory advice. One article says to buy tech stocks, another says to buy gold, a third says to wait for the market to crash first. The problem is not a lack of information, it is a lack of a decision framework. Without a clear process, any list of top ETFs just adds noise. This video is not going to give you a list. It is going to give you the framework. By the end, you will know how to evaluate any ETF, what makes one a better fit than another, and how to take your first real step without guessing. Let us start from the beginning. An ETF, or exchange traded fund, is a pooled investment product. Many investors put money into one fund. The fund owns a portfolio of assets. Each share of the ETF gives you a slice of that portfolio. Think of it like a fruit basket. Instead of buying one apple, you buy one basket that holds many different fruits. If one fruit goes bad, the rest of the basket is still there. What makes an ETF different from a traditional mutual fund is how you buy it. ETF shares trade on a stock exchange during the day, just like shares of a company. You can buy or sell at any point during market hours. Most ETFs are built to track an index. An index is a list of securities that follow a specific rule. For example, a rule like the 500 largest companies in the United States. The ETF buys everything on that list. When you buy the ETF, you get exposure to all of them at once. That is the core idea. One purchase, broad exposure. No need to pick individual winners. For a beginner, that shift alone changes everything about how you approach investing. Now that you understand what an ETF is, let us look at how it works in practice. Three things matter most: the index it tracks, the diversification it provides, and what it costs you to own it. First, the index. The index is the rule book for the fund. It defines which assets the ETF holds and how much of each. A broad global equity ETF might track thousands of stocks across dozens of countries. A narrow sector ETF might hold only 20 or 30 companies in one industry. The broader the index, the wider your exposure to the market. Second, diversification. Spreading money across many investments reduces the damage any single company can cause. If one company in the fund goes to zero, it barely moves the needle on a portfolio of 10,000 stocks. Diversification does not protect you from broad market declines, but it produces a far more stable experience than holding just 2 or 3 individual stocks. Third, cost. The main cost to understand is the expense ratio. This is a small annual percentage that the fund deducts from your investment to cover its operating expenses. Even a difference of a few tenths of a percent adds up significantly over decades. Fees directly reduce your return every single year. Here is the framework. When you are evaluating any ETF, ask yourself 5 questions before you decide to add it to your portfolio. Question 1. What am I buying exposure to? Match the ETF to your goal and your time horizon. If your goal is long-term growth over many years, a broad stock ETF may be the right starting point. If you need lower volatility or want some income, a bond ETF may play a role. Always start with the goal, not the ticker. Question 2. Is this ETF broad or narrow? Broad market ETFs cover hundreds or thousands of securities across many sectors and regions. Narrow ETFs focus on one country, one sector, or one theme. Narrow funds can be far more volatile than beginners expect, and they are harder to evaluate without deeper knowledge. Start broad. Question 3. What does it cost? Look at 3 numbers: the expense ratio, any brokerage commissions, and the bid-ask spread. The bid-ask spread is the gap between the price at which you can buy and the price at which you can sell. It is a real cost even if it does not appear as a separate line item on your statement. Question 4. Can I explain how this fund works? If you cannot clearly describe what it holds and how it is supposed to behave, that is a signal to keep researching before you commit any money. Question 5. Is the structure simple enough for a first investment? Leveraged ETFs amplify daily returns. Inverse ETFs move in the opposite direction of the index they track. Both are built for short-term trading strategies, not for long-term beginner portfolios. They can behave in very unexpected ways over periods longer than a single day. Start simple. Add complexity only when you have a clear and specific reason to do so. One of the most common questions beginners ask is how an ETF compares to an index fund or to buying individual stocks. Let us clear this up. An index fund and an ETF are very similar products. Both track a market index. Both offer diversification through a single investment. The practical difference is how you buy them. Index funds are typically purchased directly from an asset manager at the price set at the close of the trading day. ETFs trade on an exchange throughout the day, just like a stock. For most beginners, this difference matters less than the cost and the index the fund tracks. Now compare an ETF to individual stocks. When you buy a single stock, you own a piece of one company. If that company underperforms, your investment underperforms directly. When you buy a broad ETF, you own a tiny piece of potentially thousands of companies at once. The risk is spread across a much wider surface. For someone starting out, this trade-off is significant. Individual stocks require more research, more active attention, and a higher tolerance for seeing one position move sharply. A broad ETF lets you participate in market growth without needing to be right about any single company's future. Now let us talk about mistakes. These are the patterns that appear most often when people start investing in ETFs for the first time. Mistake 1. Chasing recent performance. An ETF that gained 40% last year looks attractive, but past performance does not predict future results. High recent returns often come with elevated valuations and higher forward risk. Choose based on your goal and the index, not based on what the fund did last year. Mistake 2. Buying too many ETFs. More funds do not automatically mean better diversification. If you own 5 different global stock ETFs, you may be holding very similar underlying securities in each one. Start with 1 or 2 well-chosen funds that cover your intended allocation clearly. Mistake 3. Ignoring the expense ratio. A difference of 0.5% per year sounds small. Over 30 years, it can reduce your final balance in a meaningful way. Pay attention to what every fund you own actually costs you annually. Mistake 4. Using complex products without understanding them. Leveraged ETFs are built to amplify daily returns. They are not designed to deliver double the long-term gains of an index. Using them without fully understanding their mechanics over time is one of the most common ways beginners lose money faster than they expected. Let us make this concrete with 2 illustrative examples. These are for educational purposes only and are not investment recommendations. Example 1. A single-ticker global equity portfolio. The VT fund holds roughly 10,060 stocks from markets around the world. Its expense ratio is 0.06% per year. 1 ETF. 1 allocation. If you contribute a fixed amount every month and hold for many years, you get exposure to global equity growth without making a single country or single sector bet. The lesson here is not which fund to buy. It is how clean a decision looks when you match one broad ETF to one clear goal. Example 2. A simple 3 ETF core. 50% in VTI, a broad U.S. stock market ETF holding about 3,500 companies at 0.03% per year. 20% in VXUS, which adds international exposure across nearly 9,000 stocks at 0.05% per year. 30% in BND, a broad U.S. bond ETF holding more than 11,000 bonds at 0.03% per year. 3 funds, stocks and bonds, domestic and international, very low cost. This combination also makes it easier to learn one of the most important portfolio habits, rebalancing. When one asset class grows faster than the others, the portfolio drifts from its original target. Rebalancing means bringing it back. That is a discipline worth practicing from day one. If you want to practice this before putting real money in, eToro offers a virtual portfolio funded with $100,000 in virtual capital. You can test your allocation in live market conditions without risking anything. The link to open your free account is in the description below. If you want to take the next step, the link to practice on eToro with a free virtual account is in the description. And if you want to go deeper into building your first complete portfolio from scratch, that is exactly what the next video covers. Subscribe so you do not miss it. Invest with intelligence. Think deeper.